Jim, since launching the Inflation Beneficiaries ETF in January, again, the symbol's INFL, your assets have gone straight up. I see you're approaching $1 billion right now in assets under management. In this, you own land. I understand that. You own energy, and you own exchanges. That's what's curious to me. You own the Deutsche Börse. Australian stock exchange is very big. Walk us through what you own here and the breakdown. Land, energy, and stock exchanges seem to be the main theme here.
Sure. So the unifying theme across everything that we own is capital light. So we want to remove a lot of the risk that a lot of other types of strategies and conventional inflation-oriented equities take through the capital intensity, the working capital, the balance sheet leverage, the cyclicality. And we express that through these capital light businesses that have very high operating margins, a lot of scale, and so you can really compound through a full inflation cycle. Our exposure, we do it through financial exchanges, we do it through royalties and energy, we do it through royalties in precious metals and base metals. We do it through brokerage firms, brokerages in insurance, commercial real estate, shipping. We do it through agricultural processing companies where, again, they're benefiting from the throughput. Data and research, where you can touch industrials, automotives, healthcare, a lot of industries that you don't get in these conventional in conventional allocations. But here you're getting into these niches of inflation where you're seeing a lot more inflationary forces. But here you really benefit from being kind of in that middleman or toll booth type of role where you get a lot of the benefits of inflation without the detriments of a lot of businesses that are directly upstream in the sectors or subsectors.
Yeah, and it's a fairly concentrated portfolio. The top 10 is a very large part of the overall holdings. But I see Charles River Lab, but we've discussed this before. This is a pharmaceutical lab research company. It's your number one holding at about 6% of the assets. Explain the rationale between holding a pharmaceutical lab research company.
Sure. So I think healthcare is one of the pretty hard to dispute areas of inflation over the last 5, 7, 10 years. You can kind of argue how the Fed or how the BLS massages data in other areas, but everybody's seen healthcare inflation. But it's really tough to access it, whether you go through a biotech or a pharma, because of all the capitalized expenditures and what it really takes to create the next blockbuster drug. Then when you go into kind of the HMOs, the insurance, the skilled nursing, again, you're really captive to kind of what the administration is going to do, and you have a lot of exposure to different areas within the cost curve. Charles River, their main business is contract research. So basically, they're benefiting from doing the safety and discovery assessment of very early stage of a lot of biologics, pharmaceuticals, and therapeutics. But by virtue of their network of labs, their databases, and their processes, they can do everything faster and cheaper than the leading biotech, governments, and academic institutions. So they can really scale that business and benefit tremendously from volume and pricing pressure within the healthcare ecosystem, again, without being that directly exposed to rising costs, whether it be wages or reinvestment or debt or all these other kind of areas that are more affecting the upstream players.
You know, and Anna, it seems like you're seeing something very similar. Investors are reacting to inflation concerns by adding commodity ETFs as an inflation hedge. Now, you've seen increased inflows into your commodity index tracking ETFs, DBC and PDBC. Tell us a little bit about these and what do they own?
Sure, Bob, you're absolutely right. We are observing this trend today, but it's not the first time. Every time that there are concerns about inflation, investors turn to commodities and use commodities as a hedge. PDBC and DBC invest in a broad basket of the 14 most heavily traded commodities. They span across energy, metal, agriculture, so you understand why, if there are concerns about the rising prices and inflation, you want to have access to this type of commodities. It is the same index used across the two products. They are very similar in the portfolio. It's just a different legal entity structure with different tax consequences, but we have seen significant flows coming into these funds. PDBC started with $2.5 billion this year, is now about to cross $7 billion. DBC went from $1 to $3 billion. And we believe that these flows will continue to drive assets into these funds as concerns about inflation continue to persist in this market.
Yeah, you know, commodities make a lot of sense to me as an inflation hedge. Energy has always been considered an inflation hedge. You can always raise oil prices and gasoline prices. But because inflation also affects interest rates, it looks to me like investors are adding to their portfolios fixed income ETFs that maybe can generate yield while hedging against the negative impact of rising rates. I'm very intrigued by your senior loan ETF, BKLN. Which has had inflows recently. So this is an index of senior loans issued by bank corporations. Tell us a little bit about what does that own, and why would you consider that an inflation hedge?
Sure. That's a good question, Bob, because while investment in commodities is very intuitive as an inflation hedge, BKLN senior loans are not. But if you think about the BKLN portfolio and how it's structured, you will drive a connection between inflation, rising interest rates, and bank loans. So the portfolio of BKLN is comprised of the 100 largest institutional leverage loans. They are issued by banks to corporations. And if you look at the list of the top holdings of the fund, you will find very familiar names, and they include, United Airlines, Burger King, Western Digital, and these bank loans have a floating rate coupon. So if you think about an environment in which there is a concern about rising interest rates, this portfolio is something that may be attractive to you. BKLN has attracted $3 billion year to date. Today is the largest senior loan ETF with over $7 billion in assets.
Yeah, you know, you've also seen inflows. I'm hitting some interesting inflation hedges here into the preferred ETF market. And INVESCO has a PGX, which is the preferreds. And I want you to, this is sort of an education moment for the viewers, why are owning preferred shares a bit of an inflation hedge?
They are a little bit of an inflation hedge because, again, it's the same connection to rising interest rates that is driving the flows into BKLN. These funds, and they are PGX and VRP, they invest in fixed rate preferred and variable rate preferred, and they provide income. So for those investors who are looking for income in their portfolio in the face of rising interest rates, these are securities, and this is an asset class that is definitely going to be attractive to you. PGX, that includes fixed rate preferred, has added $600 million this year. VRP, that offers a variable rate preferred, has added $15 million this year. So again, is the correlation between inflation concerns and rising interest rates that makes these particular investments incredibly compelling as part of your portfolio.
You know, Dave, most of the inflation strategies that you hear about, the viewers write in for, the knee-jerk strategy is, oh, I'll buy TIPS, you know, Treasury inflation-protected securities. But, you know, looking at these various strategies, like commodities, for example, even bank loans or preferreds, is TIPS really a good way to hedge against inflation? It doesn't seem to have much upside to it, in my head at least.
The old story is by the time you thought about investing in TIPS, you're probably too late. And I think that that's really true right now. The break even on 10-year TIPS right now is about 2.7%. That means you need to believe that for the next 10 years, average inflation is going to be north of 2.7 for it to make sense to not just buy a 10-year treasury. And frankly, a lot of people don't even want to get that far out on the duration curve right now because, as you point out, we're heading into a rising interest rate environment. It's never been more clear. So what we're seeing is people really bring their duration in. And if they're going into TIPS, they're going in that 1 to 5 year bucket, which I sort of consider cash parking, not really investing.
Yeah, Jim, just give us your overall view on inflation. Of course, the big debate in the world I live in, which is the stock market, and the debate about peak inflation, peak earnings. Are we at peak inflation concerns, and how closely tied is that to the supply chain issues?
I don't think we're anywhere near peak, but I do think it's going to ebb and flow quite a bit over the next 1, 3, 5, 7 years. But I'm distinctly in the camp that we are in a secular inflation environment. And obviously, there's a little bit that has to do with supply chain issues today, but a lot more has to do is that global governments have created and stimulated a lot of artificial demand, and that is basically colliding with underinvestment and malinvestment in a lot of the areas where this demand is flowing into, which is resulting in a structural supply shortage that's just being exacerbated right now by supply chain issues. So again, I think the biggest thing is that there's going to be a lot of fits and starts, but the overall trend is going to be higher. And as you alluded to in equity markets, the multi-trillion-dollar question is going to be, will that affect the yield curve? Because the yield curve is basically interest rates are gravity to financial asset prices. And if the long end of the curve really moves up and surprises people as it moves up, it's going to be a lead weight on equities, especially these really long duration, highly valued tech stocks that have really been the engine powering the market higher. And so that battle between interest rate sensitivity and then real, not to be mistaken with nominal growth, is going to really be the most important narrative for probably all investors over the next 1, 3, 5, even 7 years.
Yeah, and I agree. And the history indicates that moderate inflation, stock market does fine. When you get sudden, unexpected inflation, like in the 1970s, it tends to underperform on an inflation-adjusted basis.